So I can start then. So welcome everyone to our fifth webcast about peer-to-peer from ViVentor. My name is Andrius Bolšaitis and I'm the manager of ViVentor, a peer-to-peer platform. And together with me here today is Jakub Krejci, who is an investor and also a founder of a blog called Peer-to-Peer Empire. He can tell more about his blog and his path and way as an investor today. And also our main topic for this webcast today is risk evaluation, onboarding, and how investors and platforms are doing and should be doing proper risk management and risk evaluation of the loans and lending companies that are borrowing the funds on the platform. So welcome, Jakub.
Hi, Andrius. Thanks for the intro.
Yeah, Jakub, you are. You said you are Czech by origin, but grew up in Austria, and right now you are talking from Thailand. Yes.
Yeah, exactly. Right. Yeah. I'm Czech, but I did all my studies in Austria, and for the past few years I've been working online and roaming around the world. Yeah.
Okay. Can you tell maybe viewers a little bit intro about yourself? How did you start investing, and how did you end up investing in peer-to-peer, and also about your blog?
Yeah, sure. So I started back in 2017. I joined back in the days with the most popular P2P platform. I started really small to get familiar how the platform works. I got really passionate into it. I even helped to set up portfolios for my family and friends. And it worked really well. After a while, I started diversifying across several platforms. And I also joined platforms that promised higher yields and all of those buyback guarantees. And it worked very well for a few years until it didn't work anymore. And I got scammed by one of the platforms. And at that point, I realized that I should have done way more due diligence and educate myself way more about the risks of P2P lending in general, and also about the individual platforms. So in the beginning of 2020, I was investing in a few other platforms that are still ongoing. And I started reading all the terms and conditions in order to familiarize myself with the risks that are connected to my investments. And I also started researching the team behind the platforms, meaning the CEO and the founders. Yeah, and since there was not as much information on the internet about the individual platforms when it comes to the due diligence, and I've done quite some research, I was looking for a medium to publish my results, and that's how my project P2P Empire came to light.
And how is that going? How is that project going? How many readers do you have right now?
Yeah, so it took off really well. We got some positive response from a few users. At the moment, we have a few thousand visitors per month. Considering we launched just a few months ago, it's really promising, and I hope that it keeps increasing and we bring more value and transparency into the P2P lending space.
I see you review 12 platforms, right, on your website.
No, actually we have over 30 platforms right now.
Okay.
Yeah, most of the platforms, they also have the due diligence section, which I've mentioned before, and we keep improving. We keep developing more features and more tools to make it more user friendly for the readers, so they can find all the relevant information.
So you are reviewing each one of them and writing your let's say opinion about each platform, and the readers can then see let's say compare their own research with your research and see if it makes sense to invest in that platform or not, right?
Exactly. So So basically, we have quite a long process, onboarding process of new platforms. Overall, we look at more than 90 different criteria, and then we try to make it as comprehensive for the users as possible. So it takes quite a lot of time we put into every review. And we also have a dedicated news section for every single platform where we try to give the user the most recent information that might have an effect on their portfolios.
Mm-hmm. And you say we how many people are actually working in this project?
Yeah, so currently we are a small team of 5 people,
Okay.
dedicated to create better information content to our readers. We have 1 developer and a few people that are helping with the publications. We also created P2P Landing Academy, which we are at the moment building up. It's basically a library of articles that are going to help investors or users that are interested in P2P lending space to get more familiar with the risks. We also show them a possibility how to do their own due diligence. And we have a lot of cool ideas in the pipeline, which we will be publishing in the next few weeks.
Nice. And okay, so you are publishing in basically in English, right? Is it directed to some particular audiences, or is it for anyone? I mean, you cover mostly European platforms, I understand, right?
Yeah. So at this point, we cover mostly European platforms. It's only in English at the moment. We will see how the users will react to our content in the long run, and possibly also translate it to other languages in the future.
So you mentioned you use over 90 different criteria to evaluate platforms, right? So maybe
Yes.
maybe you can, because later I will also go through our criteria as well. Maybe we can talk about those as we're on the topic on your platform. How are you evaluating, and what examples you could give, like for investors to understand how you are doing the work on evaluating the platforms?
Yes. So the criteria is always developing. So the more information we get, the more criteria we evaluate in a way. So basically, every platform is very different in its own way. And we categorize the criteria in 4 different groups. The risk and return being the most important one, the liquidity, the usability, and the support of the platform. So with each group, we have a set of questions that we ask ourselves, we review and find the information. There's been no platform where we did not follow up with the CEOs or the customer support, because there was always some kind of information missing. So we usually follow up on with every single platform with questions related to terms and conditions or risk or securities. So because there are so many different platforms and different business models, we have a set of questions for different purposes. Probably not very meaningful to go into details right now. I think the users can find a lot of information on our platform, because we have also published it online, all the criteria that we review. To make it short, when it comes to the risk and returns, we are looking at what kind of securities the platforms offer. Is it just a buyback guarantee? Is it some kind of collateral or mortgage? And we try to evaluate the, I'd say, the value of those securities. So when it's a buyback guarantee, we tend to look into the loan originators who provide a buyback guarantee. When it's a collateral or let's say mortgage, we tend to look at who was the valuator of let's say the real estate project or business project. So we try really go into details and make it more comprehensive for the users, so the people understand what they're investing in. Yes, as I mentioned before, the due diligence section includes information about the owners, about the CEO, the team behind the platform, as well as terms and conditions. So basically, we read all the fine print and pinpoint relevant terms and conditions that might have an effect on the user's portfolio. We also look how their funds are stored, if they're on a separate accounts or if they are on segregated accounts. Well, let's say right now there is not a lot of platforms that give you an IBAN account number, but that's something that we will be looking in the future as more platforms go towards this way. Yes, so that's about the risks. When it comes to liquidity, we are looking also if the platform is a secondary market or if the users are able to cash out their investments before the end of the loan period. When it comes to usability, we're looking and comparing all the tools and if the platform is user-friendly and easy to use. And last but not least, the support. We are looking at the responsiveness of the support as well as the quality of their answers. Some smaller criteria are also if the company has a dedicated blog where they talk about their loan originators or the new features, etc. So we really try to go really deep and make it more comprehensive for the users.
So are you actually invested with each of the platforms on your blog?
So we are invested in a lot of platforms, but not on all of the platforms. We aim to make it more clear, but we are also working on it to make it even more transparent in which platforms we are investing and which not. At the moment, all of the platforms we are invested in are being tagged with a checkmark tested platform. So readers can see where we actually have an active portfolio.
That's a good thing, because it would be good to know if you are actually invested or not invested. So this checkbox which says tested platform basically means that you have done it yourself, yeah?
Exactly, yes. But as we test a lot of platforms, at some point we might change our strategy or just cash out because we're not convinced about certain features and just invest elsewhere. So in that case, we will uncheck the box.
Yeah. Okay, understood. And do you manage it because it's a lot of information to manage? Yeah, it's one thing to manage your portfolio in one platform. It's also can take some time if you want to do it like very in detailed mode. And in some cases, when you have a lot of platforms, it's already get cumbersome. So do you use some kind of aggregator maybe, or you log into each platform individually and make adjustments there, let's say one by one?
Yes. So no, we don't use any aggregators. We do everything manually at the moment. Personally, I haven't found anything on the market yet which would allow me to manage as many platforms. But I think in a realistic way, it's for most of the investors, it just doesn't make sense to invest on so many platforms. Like there's not going to be any value in terms of diversification at all. So for us, it's more like just testing the platform, investing, having some skin in the game in order to be interested in the latest information and report it on our website. So for most of the private investors, personally, I think it does make much more sense than diversifying between 2 and 3 platforms, because it gets, like you said, it gets really time consuming in order to manage everything. And the added value in comparison to the time spent is not as big.
Right. And you probably use automatic investments, right? Or do you make manual as well?
Well, actually, for some platforms, yeah. Like for some platforms, we use automatic, especially for the ones where we have a lower investment amount. But when it comes to real estate projects or business loans, right now we are more into the real estate project sector. We do everything manually. So we don't use the auto invest because I think that there is so much different aspects to every project, and it's worth evaluating it manually rather than just setting up the auto invest. And also the auto invest does not account for all the criteria, I think. Right. When it comes to short-term loans on P2P marketplaces like ViVentor, we use the auto invest, but for the higher investment amounts, we tend to separate, like create multiple auto invests with different options. Let's say if you want to segregate based on the loan originators. So.
Okay. So I know that, of course, the interesting part of this conversation for viewers might be also to hear about ViVentor and how we do our credit scoring and risk evaluation of our loan originators. So actually, as I said previously, I have some information prepared that I would like to share with you and the viewers, and I suggest that I just go through the slides, and we can have a conversation ongoing as we go, and you can ask me questions, and I can answer them, and we can have some follow-up in the end. So let me try and share the screen now. Okay, do you see my screen?
Yes.
And how about now?
Yep.
Okay. So yeah, this is actually a presentation that we used a while ago when we were talking to our loan originators and bigger investors, explaining about how we're doing our what are our processes for risk evaluation and credit scoring for loan originators. So first of all, we do a due diligence process about the new companies that we consider onboarding on the ViVentor platform. So it all starts by loan originator signing, writing us an application form, and sending their business presentation about the business, like a slide deck about who they are, who the shareholders are, just your regular corporate presentation, and of course the application. Then we start doing the KYC and the ML processes. It means that we are checking the owners of the company, sources of funds for the company, and if they comply with the European regulations. We have our own credit ML officer for that reason, who is like a certified expert in the field, and it's part of process as well. Then comes the credit risk valuation and rating assessment, which will go I'll go into more detail a bit in a few slides and explain more about that. And then we go through a legal framework check. We sign agreements, annexes, look at agreements that the company is signing with their borrowers, and similar things, followed by a site visit. We used to have physical site visits to loan originators, but now we have to satisfy ourselves with the video calls right now. But the aim is to visit all loan originators that we are partnering with at least once per year, so physically. And finally, we are signing the partnership agreement. So it's a long process. It can take at least a month, I think it's safe to say, to onboard a new loan originator until we complete all these procedures. And yeah, it all, of course, also depends on the capabilities to agree between ourselves on all the things, and how fast the things progresses. So that's the sort of overall process. Now, moving on is our risk management approach. So first of all, it's let's say our main goal is to have a strong anti-money laundering and know your customer rules for all loan originators and all investors. So we do the same background checks for loan originators and investors. Right now we're doing document checks ourselves, but we have signed with a third-party provider, which will help us to do even more checks about the documents and the people in sanction lists and in politically exposed person lists. So we will be more like a bank level information collection. So yeah, so what we're taking into account is that we are taking into account that all loan originators would have a certain skin in the game, Currently, all of them have 5% skin in the game on the platform, meaning that skin in the game means that how much of their own equity has to be present in the loans that they are refinancing on ViVentor platform. For new loan originators or for higher risk loan originators, we will be demanding to have higher skin in the game so that they have more money present in their own loans, which they are refinancing. Then we are doing a credit assessment. We have our own credit scoring model, which I will explain a little bit in the next slides. It basically allows us to score each loan originator and assign to him a credit to one of the credit groups from A+ to C-, with A+ being best risk, lowest risk level, and C- the highest one. The score depends on various criteria, and I'll describe it in more detail what weight we give into each of those criteria and how we manage. But as you said yourself, this is a live thing which is which we are improving as we go, because it's you learn something every time and you try to make adjustments and improvements to the model. Also, part of this process is quarterly review. So once we start working with the loan originator, we do a quarterly portfolio reviews. We ask them to actually send us the whole portfolio, anonymized portfolio, but the whole portfolio of the loans, which we pass through the model and reevaluate the parameters. So every quarter we are updating ourselves on this information. And we also do, as I said, site visits. So visit the headquarters of each loan originator, and most of them are online businesses. So headquarters mostly show the situation of sales network as well, because it is a online business. For offline businesses, of course, it would be good to have a possibility to visit the branch offices as well. So site visits, when we do them, we are publishing them as a news, as a press release on our blog, so investors can read about our findings and about how it went. So we actually wanted to do quite a lot of those site visits starting from this spring, but unfortunately we had a lockout and we are now doing them more or less online. So you could see how our conversations with loan originators are progressing as we had these webcasts before. Yeah. So our credit rating process is basically a three-step approach. We collect information about the company, about the owners. We do a risk assessment based on our criteria, and we do a rating assignment. The plan is as well to publish this rating assignment to our investors, so that the investors would also see what rating, according to our thinking, each loan originator has. We want to publish this information. We are actually about to publish it already just before the coronavirus hit us, but now we don't think it is reasonable to publish information about how each loan originator was doing in end of 2019, because then now the situation is completely different and we need to reevaluate the situation. And this is what we are actually doing right now, is we are reevaluating all loan originators based on first quarter data, but also taking into account figures from April and information from April, so that we could see how they managed the specific situation we are in right now. We hope to release this information. I don't know, it's now difficult to say when, but I hope within a month from now we can collect this data and publish it on our website. So you will see what rating each loan originator, according to our thinking, has on the platform. Yeah, here's some more info about the AML and KYC. Is that we pay extra attention to the UBO of the company to understand who the actual owners are. Is this a real business? Is this not a fake company? We don't allow by default to onboard on ViVentor platforms that are present in the business for less than half a year. So we check the history of performance as well, and what the experience the shareholders have in the field, if they are just bought the business from someone and are not experienced at all, or they have a longer history of working in finance in this business area. And yeah, so so this is it on this. And also here's the main maybe part that I would like to focus on is the risk assessment slide about how we're doing the actual risk assessment. So basically we have a risk scoring model, which is a financial model. It is long algorithm of big algorithm of various parameters, as well as in your case we have quite a lot of them, which we take into account when evaluating the risk of all of our loan originators. But to break it down, it consists of 4 main factors, and each of them is given a certain weight to the our, let's say, final score. First of all, we take a look at the company profile. It is basically like soft information, you can say, but we are able to evaluate it into some categories as well. It's what standards are in place, what risk exposure and practices does the loan originator utilize, what is the company strategy, management experience, as I said before, track record, and what risk controls they have in place. So we ask them to provide this information for us as well, followed by financial performance of the company. So we have we take a look at the main financial information from the company. Basically, we look at profit loss statement and balance sheet, as well as the this part is about the company. So financial statements of the company. We take a look at the earnings and profitability, capitalization, leverage, means how much company is funded by their own shareholder money, and also how much extra funding did they get from comparatively from external sources. So besides peer-to-peer platforms, these loan originators may have extra funding from, let's say, banks or by issuing bonds. So peer-to-peer is definitely not the only place where they can raise money, but for most loan originators it's a very comfortable place to raise money, because it is it's of course a long onboarding process, but once you're live, you're it's quite easy to get funding. It's just uploading new loans and waiting for investors to invest into them. But in bank's case, for example, or in bond case, it's a much more lengthy and time-consuming process. Third parameter is portfolio quality review. So besides taking a look at the financial performance of the company itself, we take a look as well at the portfolio. So while looking at the portfolio, we look at the not the summary figures, but we're actually looking into the raw data. We look on the detail of each individual loan which has been issued by this company for a period of time. And from this data, we calculate ourselves the ratio of non-performing loans, meaning that what is the share of non-performing loans comparing to the whole portfolio of the company. We look at the asset quality, roll rates. Roll rates basically show how loans, the dynamics of the portfolio buckets. Portfolio buckets is basically the parts of the portfolio based on how late they are in being repaid. So current bucket means that loans which are paid on time are in this bucket. 30-day bucket is the loans which are late to be paid up to 30 days. 60 days, it's loans that are between 30 and 60 days. And the non-performing would be everything else. And by categorizing the loans of the portfolio into these buckets, we can see how well the portfolio is progressing. And when we look at the historical figures of this, we can see if it is improving, is it is on a constant level, or it's in a decline. So it basically shows how well company manages to evaluate the risk of their borrowers and what the risk appetite it in general has. And it gives us a good overview of risk tolerance for the company, as well as the competence of the company to manage this risk. Yes, and some other parameters we also take into account from this portfolio, not only about it, but also about the company itself, like loss given default, for example, or parameters like surplus, which is a very good measurement of how to evaluate how the company is actually collecting the money from the borrowers. Is it collection? Are the collections going as planned, or are they falling behind on them, or are they even doing collecting more funds that is required to pay on time? So meaning that their borrowers are paying ahead of schedule even. And fourth big criteria which we also evaluate is support factors and guarantees. Some smaller companies which are young might not be so strong or secure by themselves. So in that case, we see if there are any support factors from the government, from the shareholders, and if they have any, let's say, company parent guarantees. And if they have, then we evaluate as well how strong are these guarantees and how strong is the support of the shareholders in place. So yeah, so Jakub, maybe you want to have some follow-up questions on this, probably because you had some similar questions we discussed before with you.
Yeah, exactly. So first of all, thank you for the very, very good overview. I have a few specific questions. Maybe let's start with how many applications from loan originators get accepted versus the ones that get declined?
Some of them we put on hold and don't yet how to say evaluate to the end, but it's safe to say that we onboard and accept not more than 10% of all applications that we receive. There are really a lot of loan originators in the world and a lot of countries where they are originating from. So we of course also take a look at the it's not mentioned maybe here, but we'll very much look as well at the country risk and what we know actually ourselves about the country, and if we can, by being as well a small company in Europe, if we can safely evaluate a country like, I don't know, Sri Lanka or Cambodia or some country in Africa, for example, to really understand if it's possible to know all specific about it. So for some of them, we just say no until we get a better understanding of the country specific. So it's an early no, without even going much deeper into specifics. So first of all, we want to understand if we can have good possibilities to, let's say, protect our interests in the worst case in that geography. So 10%.
Okay. All right, and you also mentioned funding sources several times. So I'm interested in do you have some kind of limits where you say the loan originator may fund maximum, let's say 20 or 30% of their loan books through P2P, and then specific limits, especially when it comes to funding from ViVentor?
So our rule of thumb, which is of course adjustable to each loan originator, but our rule of thumb that we use is that we set a limit for each loan originator to not fund more than 70% of their good portfolio on the ViVentor platform. And good portfolio is the loans that are current bucket and bucket which is not later than 30 days. and we set a limit of 70% up to that. It's quite a new parameter which we have implemented, and we will need to review that our loan originators, all of them, follow this parameter right now. So, but of course there might be exceptions if we know the shareholders really well, and if we know that there are, let's say, very strong guarantees from parent companies, etc. So exceptions can be made, of course. But
so
yeah.
the 70%, does that apply to funds just from ViVentor or from all P2P platforms? Because some of the
from
loan
ViVentor.
originators. Okay. So in theory, if a loan originator gets 70% from ViVentor, the loan originator can as well go to another P2P platform or P2P marketplace and get the rest from there, right?
Theoretically, yes. But I believe all platforms have certain rules in place, and they will ask, as we do, how much funding have you got from other platforms, and if it happens, so you cannot probably over leverage yourself like that. But it depends on each platform's, let's say, capabilities to evaluate this risk. And I think on sites like yours, it's a good comparison for investors to see if they're actually doing this or not doing that.
Yeah, exactly. That's something that most platforms are quite intransparent when it comes to showing, okay, how much funds does the loan originator get from a specific platform. So it would be good to see improvements in the future where you can say, okay, this is the total loan book and this is what we have funded, so the users have a better overview. You also mentioned, maybe it's a bit out of context, the default rates of loan originators. That's something that you're looking at. Can you comment on what's the average default rate, and let's say in the consumer loan, short-term business on the loan originators on ViVentor?
Well, it very much depends on the type of business and the country and how well is it working. So, for example, we have eBankar, who has very low default rates because they have collateral of a vehicle that is being collateralized for all the loans. For some other loan originators, it is much higher rates, but the interest rates they are charging reflect that. I think the highest they can go is up to 40% from the portfolio, but then the rates are for borrowers are in the hundreds of percent. It's these PDLs which you just borrow very, very small amounts, and these default rates don't necessarily mean that they are, let's say, provisioned. It's actually, most of these funds are later collected by collection companies. So the business model is that the lending company is on a constant basis selling the non-performing portfolios to third-party companies with discount. I mean, if you see that you're normally from your business, let's say 40% of your portfolio is non-performing, rolling portfolio is non-performing, so you find a company that specializes in collection of funds. If you don't do that business yourself and you just sell that portfolio, the claim rights to them, and they handle the collection for themselves. And from this, what they are doing, I know that in most cases, virtually all of this portfolio is collected, because as unfair as it may be, but it is much easier to collect money from individual people for small amounts than it is for big companies with big loans. So sometimes this is a much faster process than is expected.
You also mentioned that most of the reviews happen on a quarterly basis, correct?
Yeah.
Do you think it's enough to do it on a quarterly basis?
We do, like say, in-depth review, like complete reevaluation on a quarterly basis. So for this, I think it is enough, but it doesn't mean that we are not, we are silent completely with loan originators. So we have, first of all, we have daily communication and technical channel, meaning that we look at, we receive files and data from them, and we send data to them about the settlements, about the loans, about repayments, and stuff like that. and we are as well in daily monitoring. Automatically it happens because about our financial situation, let's say this funds in transit status, how much funds they have to pay to us, pushing them to pay if they're not paying, trying to get them to agree to some kind of repayment schedule if they cannot do it otherwise. So this is like an ongoing work which we do daily basis, you know. So from that perspective, I think, yeah, it's enough to reevaluate each quarter.
Okay. I'm not sure if you're gonna address this in the future slides, or if you have anything more coming up.
Yeah, there are a few slides still. Yeah.
Okay, so maybe we can go on and then discuss the rest later.
Sure. So let's go on. Basically, it's just, I think, one slide that I have here. It's our risk assessment chart. We plan to release it, as I said, when we have the updated credit risks for the loan originators, because now what we found and what status we have on them from 2019 is just, I don't want to release it because it will be like unnecessary doubts to investors. I mean, let's not we have them, but we're not looking at them ourselves because it is completely different financial situation right now for most of these companies, and we have to reevaluate that. So basically, it is the table which you will see. It is ratings from A+ to going down to C-, and D is default. We will not be having any of those companies like rated and still present on our platform. But yeah, that's the main concept that we are going to introduce in the coming weeks or a few months.
I really like the way you're doing your planning ahead. I know from my own experience when I invested in other platforms that have a similar rating criteria, as in the last few weeks, we could see that even, or the last few months, that even some of the loan originators that had really optimistic ratings got suspended in the end, and the ratings got decreased. So I'm always a bit skeptical when it comes to those kind of ratings. It would be amazing if you can support the ratings with some hard data, and like also showing, okay, what's the current default rate, what is or how many loans are late, etc. So when investors go look at those ratings, they can, because I can imagine that a lot of the investors will set up their auto invest based on the recommendation, let's say, that you make with those ratings. So it would be really good to see some additional data to it, so investors.
So the data will definitely come, and I think it's not only our platform, but it should be all other platforms that are applying now for this license model. Because if we all become the financial brokerage companies, so all the investment advice that we will give will be subject to liabilities to ourselves and to some, some sanctions or fines from the regulator if we not do it properly. So I think it will be in the interest of not only us but all platforms to provide as much information as possible to investors to make the right decision about investment. So but it's again a matter of agreement about how much information each loan originator is willing to disclose. But if I were a loan originator and I was in need of funds, I think the more information you disclose about the company, the better possibilities you have to get some funding. Even if the information is not so shining, it's still you can find investors who would be willing to risk by investing into your company and at higher rates.
Yeah, I agree with you on this one. Yeah, this you mentioned that because of this licensing agreement, that because of the license that you are applying for, you said that you will be liable for the information that you present on the platform. Is that correct?
Of course. So that's the point of the license. The point of the license is that to protect investors. I mean, financial brokerage company has to inform all investors about the risks they are taking, and to make sure that they all understand these risks, and also to make sure that they have the capacity to understand those risks, that they have, let's say, that they are not I don't know, that they understand the risks they're taking. For example, there has to be some, let's say, tests to see what level of risks you as a person can tolerate, and based on that evaluation, we have to make a recommendation. And the license means that if we fail to do that properly, the regulator can either fine us for that as a company, or just stop our license, and we will have to stop our business. So for all of those companies, that's very important to make sure that information provided to investors is of good quality, and that they fully understand of where they are putting their money.
Yeah, I really appreciate this, because as for now, when we read the terms and conditions for most of the companies, the terms say the platform is not liable for any information about the borrowers and loan originators that you can find.
Yeah, so it all started as a, all those platforms started as a fintech innovations, and when you start as a small fintech startup, you start small without many restrictions, but when the business grows, you of course are involved, impacting more and more people and their finances. So definitely it has to be regulated, and you have to be more and more strict when you grow. So this is a natural process, I think.
I have one more question regarding the monitoring of loan originators. So it has been brought up quite a lot in recent videos as well, and in the P2P industry as well, the situation with Aforti. So Aforti was one of the loan originators on your platform. What do you think went wrong with the monitoring of Aforti?
Well, to be frank, the models that I have presented to you were created, let's say, as countermeasure after Aforti. We did not have those such good measures in place before that, and it actually also was an unfortunate event that maybe not so unfortunate, but it all coincided with the transition of management. And I started working at ViVentor actually at the time when these things started happening. And when you start working, and I came not from peer-to-peer industry, I came from a bank to work here. So for me, the whole industry at the time was still new, and to understand how the company operates, how the industry operates, and to be able to spot such a thing would be, let's say, a very difficult thing to do. So that's all combined in one place, So after this happened, we took a lot of measures, like introducing the new risk scoring model, introducing proper quarterly reviews, introducing all these daily monitorings and checks we are doing right now. So I guess you can say that we have learned as a company quite a lot from it. And I wouldn't I'm definitely not calling this case as a, let's say, dead case right now. I strongly believe that we will be able to get good results from this matter, because both companies are not bankrupt. They are showing some results in other business areas, and we have a very strong guarantees that we have in place from the owners of the company, which we are working to execute. And unfortunately, it takes a long time to do because of the remote work that the government and legal offices in Poland are doing right now. So in general, you probably know that legal processes are long processes, and when it is remote work, it is even worse. So yes, but I'm a bit restricted by the agreements we have with the company to disclose like specific and details of it, because if I do, I might risk breaking some, giving them an unnecessary advantage to it. So what I could say, I think I said, and in my opinion, eventually we will be able to get back most of the debt from the company with interest to investors.
That sounds very promising. So since you have implemented those new measures, did you notice any issues with the current loan originators that you have right now?
We did notice that there are no, of course, loan originators that would be like considered as defaulted by our parameters, but of course some were higher risk, some were lower risk. We were ready to present that information to investors, but just basically in the days that we were going to present it, this situation happened, and now I wouldn't want to speculate about them. So until we come up with a updated plan, let's keep it as it is for now.
All right. Okay, good. I think
you probably a good answer about how they are doing and what reserves they had in place was the situation with funds in transit. So you saw in my previous presentation about the situation and how each loan originator is dealing with them. Some of them don't have them at all. Some of them have quite a lot of them and growing. And with them we have special conversations right now going on. By the way, while we're still on the topic, maybe the news flash part from ViVentor, it's a quite short one that I wanted to share, is that since last time that I presented the situation about funds in transit, we had quite a good improvement, and I hope investors also saw it in their investment portfolios. Is that first of all, the one of the more problematic loan originators, MyCredit from Kazakhstan, with whom we agreed on a repayment plan last week, made the first installment on schedule, and it has been distributed between among our investors. The Balkan companies, Forsa and Credit from Moldova, Macedonia, and Bosnia, have all paid their outstanding funds in transit amounts to investors. So you should, if you have invested with these companies, you should no longer see that the funds are still in transit. Also, important thing to note is that we just repaid the principal amount of funds in transit. I mean, principal with loan interest, but not with the interest for the whole the whole funds in transit. I mean, this extra interest that you would get for giving money for a loan originator to use for a longer period. So this interest we have agreed on, and we will transfer in a separate payment because it's still a technical thing to implement for us. So unfortunately, we weren't able to do it just then, but definitely all investors will receive in a few days the payment, the interest for the funds that were in transit during that time. And for some of them, it's quite a big amount. And one more important thing about this is that we are now finalizing and will be releasing a special place and page for on our website, where we will keep this information about funds in transit updated on a constant basis. So you will be able to go into that place and see the updated information about each loan originator and their funds in transit. And I think it is a very good measurement, which credit risk, of course, is also a good measurement, but funds in transit status basically shows how well the loan originator is able to cover the debts to investors and how fast they are able to do it. So this, at least, information we'll be sharing with our investors in very, very short time from now.
It's very good news. I really appreciate the format you have chosen to improve the communication with investors, and also I'm looking forward for the improvements on your website that bring more clarity and transparency when it comes to individual loan originators. I think it's a very good step, and it will help certain P2P platforms to differentiate themselves from the rest. So from my side, it's really promising and very good efforts.
So thanks. I also think that being a retail platform, I mean that most of our investors are private individuals, and for them to feel not safe, but to feel, let's say, present and up to date on information, is critical to have a ongoing conversations with them. And for these reasons, we want to have this webcast with our investors, with our loan originators, with industry leaders to discuss the topics, the situation, and how well we can progress in the future. Yeah, so Jakub, you have some maybe follow-up questions based on the things we discussed?
No, I think we've went through all the questions, and the ones that I didn't ask you already addressed. So from my side, I have no more questions.
Okay, then Jakub, thank you very much for joining me today on our fifth webcast on peer-to-peer investments. I think it's good that we managed to have it much faster, much shorter than we did previously. I saw a lot of comments saying that I don't have time to listen for 2 hours to these webcasts. So now it's going to be less than an hour, definitely. Maybe next time we will get even faster and more concise information. So thank you once again for joining, and stay tuned for our next webcast. So we will be announcing who will be our next guest very soon. Thank you, everyone, and bye-bye.
Thank you. Take care.